All right. It is what were we saying? Live at 5.
5 at 5.
Live at 5. Jeb Smith, Josh Lewis, Buywise Mortgage here to give you a real estate market update, housing update, mortgage finance, everything in between. Here to answer your questions. And we appreciate you guys being here. If you have a question, leave it in the comments below. We've got a lot of news that came out in the last couple of days. We got some inflationary news today. Fed talked about interest rates, which I'm sure we'll dive into. Josh, welcome. Anything you want to put out there to start the show?
No, as usual. So, a big thing that we've been talking about, I do believe strongly that the long-term trend for rates is to continue lower. And what happened today is kind of what we tell people on any given day in any given month, even though the longer term trend is for them to be down, things happen on a given day. And every month, our big wild card for the year, a few years back, say 10, 12 years ago, actually before the crash, the big one was the monthly employment figures. We never knew what was going to happen. It never seemed to hit at where it was supposed to. It was either too hot, too cold. So we would just say, let's lock and stay the hell away from the jobs report. The one for the last 3-4 months has been the Fed meeting. So we had a Fed meeting yesterday and today. We had a Fed announcement and press conference, and as usual, they said things that with the basis in fact. They're economists. They're not just pulling numbers out of thin air, but had a lot of selling today. So rates in general, at least 1/8%, if not a full 1/4% worse today, which is pretty subdued in light of the things they were talking about. So later on, we'll go into some more detail of why I don't think it's a change in trend or going back to where we were in March, where rates had spiked up. But for the short run, we had almost all of our clients locked, and the ones that weren't locked got locked this morning, right when the market started going sideways. And that's the reason why. You had just done a video this week, when, why, and how to lock an interest rate. And it's important to know that even in a longer term downtrend, things can happen. You have longer term trends that were pretty consistent and confirmed, and then you have shorter term trends. Anything within a 4 to 6 week time period, which coincides with how long you're in escrow to buy a home, things can go against the longer term trend. We need to be aware of it.
No, and I think that's important that you mentioned that, because often I talk to people and I'll comment back to people on videos or what have you, and I say, I don't expect, I'm expecting the trend of housing to kind of continue in the same direction, right? Which means moving sideways to up. And I always go back to housing supply, demand, and the fact that interest rates aren't really going anywhere. And when I say, interest rates aren't really going, that doesn't mean that they're going to go down every single week or that they're not going to adjust up at some point. Yeah, they're going to move a little bit, but we're talking historically speaking, interest rates are going to stay low. You've mentioned, several times that you don't see them really going over 4%. And I'm right in the same page. If they adjust a quarter here and there, not really a big deal. And we just actually got some news today. Lawrence Yun, economist for the National Association of Realtors, came out and basically said that we are behind 5.5 to 6.5 million homes. So think about that, right? Everybody wanted to talk about forbearance, and they wanted to talk about what happens when all these forbearance properties hit the market. There was, at the moment, I think we have around 2 million or so that are in forbearance, and you can call them delinquent or whatever, but the fact is they're allowed to be in forbearance. They're allowed to miss their payments, but that's 2 million homes, right? So if we're behind 5.5 to 6.5 million homes, and this year they're only going to build around 1.7 million, these are big numbers. And he goes in there, and I'm going to talk about this more in a different video, but it more or less confirms that the trend of what we're seeing for the time being.
No, the 5.5 million number is just a staggering number. We've talked about this. Home prices are always going to be dictated by supply and demand. Right. So 5.5 million shortage from long-term trends, while we also have a spike in the long-term trend of people coming into prime home buying age, the millennials hitting that 31, 32, 33 prime home buying age. So you have more home buyers, you have less supply. We have a pandemic last year where people started focusing more on being in their home, and it shot rates or dropped rates to the floor where homes were more affordable. So what we've seen is perfectly rational when you look at the bigger term picture. Now, what we've talked about, we get questions here every week. When's the market going to turn around? When's the market going to crash? You have morons on YouTube every week with their clickbait headlines talking about the 2021 crash is here. They also did the same video last year. The 2020 crash is here.
Right.
It's not coming because nothing of value crashes in value when there's a limited supply and more demand than there is supply. So we can see this moderate, and we all hope that it does moderate. We had been in like a Goldilocks scenario where we had 4 to 6% appreciation for 2, 3, 4 years in a row. That's great for everyone. Everyone's building up equity in their homes. Home buyers can still afford. Double-digit appreciation is not something that anyone wants unless you're planning on retiring tomorrow and selling your home and cashing out. Maybe you like that. But for everyone else, it is not good having those big numbers. So are we likely to crash? No, there's no crash anywhere in the world. But what we all are hoping for is to see that moderate, where we can get back to 3 to 5% appreciation annually. And we have a long ways to go. You already see questions are flying in here, and several of them are just like just exactly that. Is the housing market moderating? Are things cooling down? And you see it in the headlines. And I was thinking about this morning, knowing we were going to do the call tonight. I said, just ignore the news, because like when things are good, they hype it up to be even better and to spin a bad thing about it. Home prices, affordability is at all-time lows because home values spiked 14% last year. Well, that's not true, because interest rates are lower for home buyers, incomes are higher, so affordability is worse than the year before, but still at relatively good levels. Now, what do we have? We have a limited amount of supply, so year-over-year sales numbers are down. What do you see? Now the media, this housing market is cooling, leading to fears of a crash, leading to the Fed. I see a headline this morning. Fed poised to take action and jack up interest rates to control spiking inflation. If you look, I shared a report with you last week that we had a hot PCE figure last week, and when you look at it, there was like 3 elements in there, or 4, that had shot to the moon, and they were all pandemic related. It was air travel, rental cars, and a couple of other items. And you look at it and you go, yeah, they went and dropped to the floor last year, and now the market for them is coming back and they shoot up. So year over year, you have this big number. Inflation is not a problem. We went from a year of deflation last year that was pandemic related. We are in the middle of inflation right now that is pandemic related. And you flash forward 12 months, the fundamentals that were in place in 2018 and 2019 will take control again and exert themselves. We're not going to get 2% inflation. We go back 12, 14 years, the Fed has been doing everything they can to force feed inflation into the economy, and they haven't been able to do it. What makes you think they're going to be able to do it now? There's no magic. Nothing's changed.
Right.
We had this weird 2-year pause in the economy, and it will go back to normal. Supply chains, we talked about this. We get a question every week. Well, what is my builder going to do with lumber prices so high? So lumber had got to almost to $1,700 a board foot, and it was floating around prior to the pandemic, plus or minus 400. So over 400% increase. And now we've given back, it's just under 1,000. And in 6 to 12 months, it's going to be back in that $400 a board foot range. That is what fundamentally supports the long-term supply and demand. So we've got lots of distortions in costs due to supply chain issues. Some of them will resolve themselves fairly quickly. Maybe some of them take 2 or 3 years, but the long-term fundamentals will come back into play in everything. And the long-term fundamentals, population growth, undersupply of homes, inability to fill that gap of more homes in a short time frame. And remember that when we're talking about supply and demand and additional supply of homes, anyone that's going to build those homes, you talk about the downsides of capitalism. The downside of capitalism is a home builder says, what can I build that I can make the most money off of? America is looking and saying, what can we build that solves the problem? We need lots of first-time buyer, 1,500 square foot, 3-bedroom, 2-bath, single-family homes. No one's going to build that. That's not where the profit is.
No, understood. Yeah, no. So that good explanation. I think there's a lot of value in that. Obviously anybody we're going to get a lot of housing questions, so we're just going to reference them back to that. But let's start answering some questions. Jennifer Lego is here, one of our moderators. Thank you, Jennifer, for being here. Nightbot's already throwing some daggers out there, so we got that working in our favor. Manpinder 28. See any slowdown in the Sacramento market? Not as familiar with Sacramento as I am in Southern California. There's another gentleman on YouTube, Jason Walter, covers the Sacramento area. I would maybe check out his channel. He covers his market a little bit more in detail. But the easy answer is no. I don't think you're going to see a lot change in that market. It's one of those markets that people have fled to because they've left bigger cities like, San Francisco and some of the more expensive cities like San Jose and all of those. And Sacramento seems to be the place where a lot of those people are migrating to. So I think you might see a pickup in inventory, but I don't think that you're really going to see too much slowdown in the housing market itself. All right. Let's see here. Go ahead. Do you have something? Nope. All right. So logical thinking. Go ahead.
No, I was just saying there's some numbers I'm trying to pull up, and I think we're having a little bit of an internet issue here because I'm not able to pull it up, and I'm getting you stuttering a little bit. But let's see. We'll circle back to the data if I'm able to get it.
Got it. So logical thinker, with homes being bid and sold above the ask price, are you seeing appraisals also come in above the ask, or are appraisals coming in at or below the ask price? So this is a question I'm going to throw to Josh because clearly he sees a lot more appraisals than I do, being on the loan side of things. It's rare that you actually, when you're representing a buyer purchasing a home, it's rare that the appraiser really takes the time ever to bring an appraisal in above the purchase price. It's never really been something that I've seen a lot of in my career. But I will tell you, in the last couple of transactions that I've actually had appraisals fall short on an appraisal. One, we knew it was going to be because we went quite a bit above where we thought it would list or where the appraisal would come in, and we got the price and the buyer waived the appraisal, so all was good there. And then we actually had a buyer in the Lakewood market that their appraisal came in quite a bit above where their purchase price was, which I was actually surprised that the appraiser took the time to bring it in. But typically speaking, appraisers tend to bring them in at the purchase price versus really trying to stretch the value and bring them in at whatever that number is. Josh, what are you seeing on that front?
There's really no benefit other than, we've talked about this, USDA loans. If the appraisal comes in higher, you can use the overage there to cover closing costs. On every other loan type, it does not make a difference. So for that reason, appraisers are not dumb. They might be crazy, but they're not dumb. They know that there's no benefit in it. So for the most part, I'll see in a given year 1% of our purchase appraisals come in above value. So we are seeing them come in below value. And for the most part, it's not the appraiser's fault. Even though the market is saying, hey, there's 5, 10, 50 offers saying it's this value, there are no comparable sales to support it. And the guidelines that they operate under focus on the comparative sales analysis of saying what else has sold. So if we don't have a comp that can be adjusted to support it, it's really hard for them to do it. For the most part, they've been doing their best. We've had a few bad appraisals this year, but for the most part, they're pretty good. My biggest bone to pick with appraisers, and I know we have a few of them here that watch and pop up in the comments section, is that most of them have turned into extortionists recently. So if you want to pay what a normal appraisal fee is, they tell you it's a month to get your appraisal back. But if you're willing to pay twice what a normal appraisal fee is, you can get it in 5 to 7 days. We had one today that the offer or the assignment was accepted, and 4 days after accepting the assignment, oh, I'm sorry, I misquoted. I need another $125. So we go from 15 years ago, we got to select our appraisers. You could deal with professionals that honored their quotes, that stuck to turn times, and now we are completely firewalled from the appraisers. So they're accountable to no one, including the appraisal management company that hires them. And the reason for that is there's a shortage of appraisals. So some of this, they are truly pushed back. There's not enough appraisers to do all of the appraisals. But because of that, they know that no appraisal management company is going to tell them, I'm not giving you any assignments going forward. I mean, if they egregiously failed at their job, they would, but they're getting away with murder now, and it tells you why we don't want to manipulate and put a bureaucracy in between the person that receives the service and the service provider.
No, absolutely. Sam Ferris, any info on down payment assistance programs? Unfortunately, Sam, depending on what state you're in, will dictate what programs are available to you. Rarely are there any nationwide down payment assistance programs that apply to everyone. More, based on state, county, where you're located, so on and so forth. So, we've talked about this before. Josh has even mentioned it. Here in the state of California, we really have none because there's not a budget for them. They were removed from the budgets some time ago, and they've just never made their way back in. And then you have states like Texas that has hundreds of down payment assistance programs. So it's really about getting in contact with a lender in that state, a professional that does business in that state, and they can probably guide you in the right direction to find some of these programs. But as far as me referring you to a place where you can find those, I'm not aware of any at the moment. But that will put some on my radar. Well, I'll try to find maybe a common site that has some listed. Are you familiar with anything, Josh?
Yeah, let me Google it. I don't remember the name right now, but we'll put it in the comments here in a second, because there is a nationwide database, and it'll give it to you. So let me find it.
All right. So Cindy Juggle Goddess. Yes. Hi, I was gifted a property some years ago. It's my primary residence, which I plan on selling. For figuring capital gains, do I use the cost basis when it was gifted? Yes. Yeah. You're going to use the cost basis of when it was transferred to you, and then you'll get your capital gains off that. $250 for a single individual, $500 for if you're married and you've got to live in the property 2 of the last 5 years as your primary residence. So that should answer that question for you. Gerald B. Yesterday locked in my rate. My new construction home is expected to close early August. Homeowners insurance, do start shopping for that now. So here in Irvine. So Josh, when do you recommend start looking at homeowners insurance if you're closing in August, 2 months from now?
It's funny. It's one of the ones that we've been talking about. If it's 2 months from now, I would do it now. There's no reason to wait. One of our biggest delays on purchase transactions is that no one thinks it's all that important. They go, I got my car insurance. I'll just get it from them. And they wait and they wait and they wait because they don't want to get on the phone and go through the whole process. It's not that bad, but it's 10, 15, 20 minutes on the phone. And so we end up at the very end and saying, hey, we need the insurance, because all you're going to do is get a quote. You're going to provide the insurance agent contact info and the quote, and then your escrow officer is going to order the actual policy and bind the policy. So there's just some steps involved in that. You're way ahead of it at 2 months, but I would do the shopping now just so you're not surprised. You're looking, do you say Irvine? Irvine is unlikely to be in a high fire hazard area, but the unpleasant surprise we're dealing with a ton here in California is if you're in one of the hillside areas that's a high fire hazard area, we're seeing some astronomical numbers for hazard insurance.
No, absolutely. It's one of those things, like you mentioned, that people wait till the last minute and then they're scrambling to find out who. I mean, the nice thing is now if you start looking, you have the availability to shop it around a little bit, right? I mean, it's your who you have your car insurance with isn't always the best option. So the earlier you do it, the better opportunity you have to find the best rate. So I would say time is of the essence.
And Jeb, for Sam, I just threw it in there in the comment section. It's downpaymentresource.com. They list everything nationwide. What I would say is it almost goes too far. There's programs that are either unfunded or whatever. It's going to give you the whole fire hose. So weed through there, search by your area. It asks you some criteria about yourself to see what you're eligible for, and then you can make some calls and see if there's anything that makes sense.
Gotcha. All right. So there you go. Alfredo will touch on fixed payments here or 30-year fixed rates here in a little bit. So just hang tight on that. Let's see here. I saw a question. Now I lost it. All right. So Jennifer says it's absolutely free to hit the like button. So please do that if you guys enjoy the content, you find it helpful. So Echo you. What happens to the equity built up in a property that is purchased at 1.9, but in 5 years' time is only worth 1.7? There's a market softening and interest rate increase in 5 years. So Echo seems to have the crystal ball, Josh, that we've been wanting and looking for. But what happens to the equity is it's gone. It's like owning a stock, right? You own let's use Bitcoin, right? Bitcoin, everybody wants to talk about. Bitcoin went from, whatever it was up to what, 60,000 or so a coin. It's now down to what, 40,000 or so, give or take. I don't really follow it that often, but lost 20,000 based on those numbers. It's gone, right? It's not real money until it's cashed out and put into your account. So as until you've either pulled the cash out of the property or sold that property, it's not real money, right? And just so it's equity, but not real equity until it's cashed out.
There was a book about 15 years ago by a gentleman named Douglas Andrew that was called Missed Fortune. And his point in there is that you only wanted a home one of two ways. You wanted 100% financed, or you wanted to own it free and clear. And the reason for him was saying is that equity is not an asset. Until you cash it out and put it in your account, it's never an asset. So in that situation, we don't have 100% financing like we did at that time. But for him, he would say, if you can qualify for a $1.9 million loan, take the $1.9 million loan, put the money in the bank, because if it drops, you walk away and you have your money. But what Jeb said is exactly correct. Equity isn't intangible until you sell the house and convert it into a tangible asset.
There you go. Shatiria Taylor, I'm interested, or Teria, I'm interested in refinancing. Currently have an FHA loan, current interest rate of 3.2%, but considering maybe conventional, will I still have to put that 20% down in a refinance? Josh, going from FHA to conventional refinance, do you have to put money down to do that?
The loan to value on your refinance will be determined by the appraised value. So let's say you had bought for $300,000 with 3.5% down, you have a 290-ish loan. Now, if that property goes up to $360,000 when it's appraised, you don't have to put anything down. That intangible equity that went up prevents you from having to put the money in. Now, if it's gone up to $310,000 and you want to switch over to a conventional loan and get rid of the mortgage insurance, then you would need to bring the money in to take it down to a 80% loan to value or lower.
All right, cool, very good stuff. Let's see here. I scrolled down and I completely lost where I was. You guys are commenting a lot tonight. Appreciate it. Let's see here. All right. Michael DeRee, regular here. Thanks for tuning in, Michael. Do you pay closing fees each time you decide to refinance? Josh, refinancing, am I paying costs every single time?
There are closing costs every time you do a loan. So the ones that are always going to be there: escrow, title insurance, recording fees. So all of that stuff is going to be there. We do a lot of our loans no cost. So people go, oh, so it's a free loan. Well, it's not necessarily free. What happens is you take a slightly higher interest rate, you get a credit from the lender to cover those costs. The reason why we do a lot, if not the majority of our refinances that way, is going back to 1982. We've been in a 40-year bull market in interest rates. Interest rates have gone down, down, down. So in essence, what we're saying is do a free loan today so you have no sunk costs that you would never be able to get back. So if in 2 years or 6 years, when rates go even lower, we can do it again at no cost, and you always protect your ability to keep rolling down. You might be leaving 1/8% of interest on the table, but over time, when we pencil it out, you can see how much it saves.
Yeah, and then often I'm kind of go down a rabbit hole here. I've get people asking about discount points, right? The other day, yesterday, I think, I don't even remember what day it was, I posted that video on locking your rate. Get people saying, hey, should I buy down points? Should I do this? Should I do that? Exactly what Josh said right there is the reason that you shouldn't buy down points, right? If rates are trending downward over the since 1982, and we haven't broken that trend yet, chances are, they're going to go lower. If you're in a position, you might be in a position where you could refinance, take that lower cost without having to actually pay those fees up front. And so, typically speaking, buying down your rate, if you're trying to get your rate down to a point where it will actually impact your monthly payment enough, you're going to pay a pretty good premium to do that. It doesn't make sense if rates are going to continue going lower in the future. So just something to throw out there.
No, it's a really good point, Jeb. When you look, lenders are really smart. You think in terms of the one loan you are doing and what you think you know about your future. The lenders are making hundreds of thousands of loans. So they know in aggregate, this group of loans will run 4.5 years. So we want to yield X amount, meaning we need to get an interest yield over that time frame to meet our requirements. So if you want a lower interest rate, they say, cool, pay me some money up front. In essence, you are just prepaying the interest over the time that they think in aggregate an average borrower that they're making a loan to will hold that loan. So if you knew for a fact you were going to be there for 12 to 15 years, rates were never going to go lower and give you an opportunity to get that rate for free, it might make sense to pay the points. But the reality is it's a sunk cost. You can never get it back. The break-even point is anywhere from 5 to 8 years, and that's before you take into account tax benefits and the time value of money and what else you could have done with those points in the meantime.
All right. Elsa, is it possible to go to underwriting for a conditional loan approval without locking on the rate? New construction is not due to be completed until the end of November. Builder wants approval soon. The easy answer is yes, absolutely. You can definitely go into underwriting without locking the loan. Yeah, I mean, that's the answer. So anything you want to add on that, Josh? Just
people always ask, when's the latest I can lock? So am I preventing anything by not locking it? The only thing you would prevent is getting your loan docs. Obviously, they have to know what your lock is and the pricing on that before they can send your loan documents out. So let's say the latest you're talking is about 7 days before closing, but probably 10 to 14 days in order to get the loan locked, docs prepared, out, and closed on time.
All right. Let's see. Jesse said, just closed. Escrow appraised $40K less than the asking price. Seller agreed to the appraised price. Awesome. Congrats to you. That's how it should work in most cases, but it doesn't. Josephine Mckay, do you have any good news about the 25K or 15K for the first-time home buyer program? No, not aware of any updates on that front at the moment. Oh, what did I do? I somehow... Oh, there we go.
Maybe the Nightbot locked you out.
Yeah, it would be awesome. I could go home. Let's see here. All right. So, MD, how do you foresee the housing market in Miami, Florida? I can profit by selling my house, but I can't afford to buy anything for now. Should I sell and wait for the bubble to burst? It's going to burst or flourish in Miami. Is it going to burst or flourish in Miami? Honestly, I have no idea, right? I don't know where the market's headed in Miami. I do know Miami is one of those cities that tends to overbuild in some form or fashion with regards to high rises and condos and all of that. They were one of the cities that got hit the hardest back in the last housing crisis, whatever you want to call it, just because they overbuilt. They just had so much supply and things changed and they got hit hard. Now, some of the reports that I've done recently, they have, some of the highest negative equity growing in that area. And what that means is if prices were to pull back, that area would get hit probably the hardest with regards to negative equity. Now, that doesn't necessarily mean foreclosures. It doesn't mean really anything unless people actually stop making their payments and things change. Now, keep in mind, most people's payments are fixed. They're low, probably less than they can rent for. So most people aren't going to be in a position where they just let their property go, I don't think. So I think Miami, along with a lot of other cities, are going to continue to have some sideways, and probably upward movement. Now, if things do change in Miami, you're probably not going to see any drastic, huge changes in the market. So, Josh and I, every week we answer this question: sell now and do what? And if you're not in a position to buy something now, what are you going to do? Yeah, you can profit from your home, but are you going to go rent? If so, what are you going to pay in rent versus what you're paying in your mortgage right now? I know people that sold a year and a half ago because the crash was coming, and guess what? Those people just missed out on 20% or so equity, and chances are they're priced out of the market now. So, it's tough to foresee. The future. Everybody wants to predict and sell at the top, buy at the bottom, but it's not realistic. So just have a plan. Don't do things because you think you know more than everyone else. I mean, it's tough. I mean, we're in real estate. I'm in real estate. There's no way I would have told you that we would have seen the growth that we've seen, but now that we're seeing it, I don't see much changing just because of the fundamentals in the market, which we talked about at the beginning of the show. Josh, anything you want to add on that?
A couple of thoughts here. So all real estate is local, meaning not just local to your state. Jeb and I are in California, but someone just asked about Sacramento. We said, hey, I have an idea about Sacramento. I help clients with their financing in Sacramento, but not nearly as much as my hometown here of Huntington Beach. So I can tell you about Florida, but Miami is different than Sarasota. So it's important to know that. And what I was going to say is a gentleman that I know is probably the best real estate economist and investor. So, I mean, he's not an economist, he's an investor who's educated himself as an economist to make money. He is selling all of his properties here in California and putting them into new construction homes in Florida. His feelings are on that is that you have no state income tax, you have a good climate, you have lots of room to build. People, the migration figures tell you people are going to Florida. So again, I don't know where he's buying. I actually think he's on the Gulf side. So Miami would be different, but there's lots of things that Florida has going for it. And I wouldn't try to time the market because there's nothing that tells me it's going to dip anytime soon. And then also what I would want to say is let's not look back. People are always fighting the last war. So if you go back and you say 2007, 2008, just exactly like Jeb said, massive overbuilding of high-rise condos, mainly for second homes for rich people. And they sat there empty for 5-7 years until the projects could get completed and people would buy them. So when you saw those that were $1 million condos that ended up getting sold for $100,000, don't look back and think that happens. A normal market drawdown is 10 to 20% from the top.
Home. That hit home. God, that really hit home. Josh, you just reminders. Oh, boy.
The clubbing days as a Miami real estate investor, Jeb.
Oh, wow. You know, there's stories that go deeper, guys. Let's see here. So
don't say things like that, Jeb, because they're going to want the stories. They're going to say, stop answering questions, just tell stories.
It's too long for that. So C Vang says buy now or wait. I think we just answered that. I think if you're in a position to buy now, you're comfortable buying now, you know, you're in a safe spot, you don't feel like you're stretching yourself. I think buying now is the right thing to do, because I do think home prices are going to continue to appreciate. Now at what level, hard to say, but you know, I don't think you're going to see the prices that we see now this time next year. I think they're going to be higher.
Jeb, what I was saying before we went and took the detour to your history of Florida investing was that people look back and they go, I'm going to get an opportunity like 2008. At some point, there will be a peak and then it'll be 50% of the peak. That doesn't happen in a normal market. And we are in a normal market, meaning that all of the buyers are putting their own money down and they're qualifying for the loans. So if and when the market turns down, supply and demand comes more into balance and values decrease, you'll see a 10 to 20% drawdown from the future peak, because we are nowhere near there. If we get 3 more years of 4% gains and you had a 20% drawdown, you're only to where you are today. So I wouldn't wait. Get into a home when it makes sense for you in terms of your life. You've saved money, you've got a good job, you've got good credit, your family's stable, not going to be moving for a job or to a girlfriend or boyfriend or fiance in another state.
No, good stuff. Manpinder 28. Again, another question. As people going back to work, things returning to normal, do you see any impact of this in the housing market in the next few months? Yeah. So, you know, a lot of companies, right, are figuring out the future with regards to bringing employees back, whether they're going to have some sort of full-time back at work, some sort of hybrid, or they're going to be able to work remotely. So I think some people will be impacted by this. You know, a lot of people moved with the idea that they were working remotely, and hopefully those people that moved verified what the future looked like with that. But even then, there will likely be some changes. But I think the majority of these companies are going to allow some sort of at least hybrid type of environment. I mean, there's been surveys done on it, and the majority of companies out there, you know, in the last survey that I read said that they were going to go to some sort of hybrid model. So, you know, what does that mean? I mean, I don't think you're going to see, again, the real change in the housing market, but will some people maybe have to sell their house to get back into an area to go to their job? Possibly. Or maybe they just take another job in the area that they're located in. I mean, you know, the biggest are those that are, you know, taking the incomes from, say, like states like California, and living in states where it's a lot less expensive to live, you know, in you know, more rural areas. those areas, if those people do have to leave, those areas might get impacted by that, because I mean, most people that are having the California incomes aren't just going to say, you know what, now we'll take the income of this state if it's significantly less. Most of those people are going to try to regain some sort of employment with the income that they had before. But again, it's all guessing. Like it's really hard to say. And a lot of these companies that are still pushing, I mean, are a year out. I mean, Facebook came out yesterday or the day before and more or less said that they're going to allow employees to work from home. And so a lot of these bigger tech companies are going to do that. But again, it's hard to say. And I think you're probably 6-8 months out before you really even know the start of how these companies are going to respond.
I read an article earlier this week, Jeb, and just like you said, there's no answers. There's a lot of questions. And the question that this article posed was a lot of people, a lot of wealthy people in the New York area, they wanted to get the hell out of New York City. It was sort of ground zero for the first outbreak. They were able to work remotely, and a lot of them were buying second homes. They're saying, okay, now they had this second home that you could go work from. They didn't sell their home in the city, but now that things are normal, there's not an outbreak, and they need to be there for their job. Are they going to sell those properties, or do they love the second home lifestyle? Is there going to be a bunch of them on VRBO? We don't know. There's more questions than answers. We can hypothesize about what's going to happen, but only time's going to tell us.
All right. Francisco.
Go for it.
Uriostigwe.
I'll go with it. I'll give you an A for effort.
I have no idea. We are first-time home buyers, and we have over 80K saving with good credit, but we're confused on whether to wait a little longer and keep saving or buy now. So Josh and I had this conversation some time ago. I think the statement was actually made by Josh, and it was pretty profound. And the statement was, what was the statement?
You cannot save as fast as home values go up, and it's because of leverage. So let's say you guys have 80 grand. Let's say you've been saving like a madman, $20,000 a year for the last 4 years. So if you're looking at a $500,000 house and it goes up 5% next year, that's 25 grand. It would still put you further behind than buying today. If you were to buy that house today with your $80,000 and it goes up 5% next year, not only do you have that $25,000, but you've paid down $12,000, $15,000 on it. So there's no world in which you can catch up. The only person who should be waiting is the proverbial crystal ball person that Jeb talks about, that knows for a fact that in the very near future, home values are going to drop.
Yep. There you go. All right. Mike Stiles, what are the options if the market crash and I buy a $500,000 house lower by 350? What, Mike? I don't see a crash coming. I mean, your option would be that you sell the house, short sell it for less than you paid for it or owe on it, or you let it go. I mean, those are your two options, or you try to modify it. Outside of that, there are no options.
Well, Jeb, let's use Mike's hypothetical as an example. Is it going to drop in the next year? No, it's not. So let's say that it moderates from 12% growth last year to 5%. That $500,000 house is now worth $525,000. You paid it down $12,000 or $15,000. So now instead of owing $480,000, you owe $465,000. So let's say it doesn't crash next year. It goes another year. Now you're worth $550,000, $560,000, and you've paid it down to $450,000. You're not getting a 30, 40, 50% crash. At some point in the future, you get a 10 to 20% correction, but it's from that future value. It's going to be, in this hypothetical example, $560,000, $580,000, $600,000. So if it drops 15%, it's worth $510,000. You paid $500,000. I get it. I totally appreciate and respect that all of you guys here are trying to be smart and not do crazy things. And a lot of it may be because being of that millennial generation coming into prime home buying age, what did you see? You saw your parents, your friends' parents, people lose homes. It was all over the news. It was a big pain point, and you're trying to avoid that. That was a very different situation. That's not to say that we will never see a correction or a downturn in home prices. We will. We're never going to see a home price crash again that resembles anything like what we saw in 2008. It will be a correction of 10 to 20%.
All right, there you go. Probably the best comment that we've seen tonight. Josh saying that Josh's shirt looks, or Michael saying that Josh's shirt is much improved. So
you two are
no truer
jealous.
Words have ever been spoken.
This coming from a guy who was wearing a gray on gray shirt.
Rey Campos, what's your take on Riverside for investment property? So, we talk about investment property all the time. I think there are better places to invest than than California, just because California requires so much money for the down payment. Yeah, you get the appreciation, but it takes a lot of money to cash flow. Now, if you're sitting on piles of cash, great. But I think there's better opportunities. But to say Riverside, if you have the money for the down payment, it makes sense to you. It cash flows, whatever it is you're trying to accomplish. I think Riverside's fine. I mean, there's a good rental market out there in that area. Home values are going to continue to appreciate in that area because people are moving out of areas like LA and in Orange County just because it's become so expensive. And people are now, again, with that hybrid work environment, people are able to work from home. And so people want more, more property for, more bang for the buck, if you will. And typically speaking, going out to areas like Riverside, you get that. So from an investment standpoint, I think it could do very well. But it costs a lot of money to put, to actually make it where it probably makes sense as far as the cash flow standpoint. So just, you got to weigh your options.
Right now, I'm really angry. The data that I wanted for the Sacramento question of what the Sacramento market is, they're similar. Riverside and the Sacramento areas are similar in that they are lower priced areas just outside of very high priced metros. As a result, they have more room to go to the upside before they hit their affordability limits. That's really where we see a correction in home values, is when we reach an absolute limit where home prices can't go higher based off of there's no one left making enough income that doesn't own a home that wants to buy a home and push them higher. I'm still having trouble. The website's down for accessing the data. But if you're going to buy in California, I would lean more towards inland areas like a Riverside, like a Sacramento, because the price points are lower, the cash flow is better. But much like Jeb said, roll over to Arizona or to Utah or Texas, and you're going to see even better numbers. They may not have the appreciation that we get in California, but those are all things that you need to take into account. The most important thing, Ray, is that your little avatar, I wanted to put mine up here because she's even cuter than yours. So she wanted to just say, hey, I don't care where you buy, just make sure you have a bulldog.
There you go. All right. Jesus, what are we doing on this thing? Here we go. So Michael DeRee, another question, was told in Texas a home cannot be bought over the appraised value. Never heard that. I'm pretty sure you can buy it if you're willing to pay the difference in the appraised value and what the bank's willing to lend. I don't know who's going to stop you. That would be a new one for me, but I don't think that is accurate. All right.
It's Texas, not Russia.
There you go. Maximum Payne, thoughts on falling lumber price. Do you think it's a foreshadowing of the housing market cooling down? No, I think it's exactly, I mean, the lumber went where it did because of supply and demand. Simple. It will correct itself, as we mentioned at the beginning. A lot of people have the question of, well, when it corrects itself, are the builders going to basically lower prices? Are going to pass that savings on to the consumer, to the buyer? And the answer is no. As long as demand stays there, people continue to buy new construction at the higher prices. Guess what? These companies are going to continue to sell them at those prices and profit that money. At least that would be my thought. When you have, a lot of these builders are egregious in how they're approaching things and what have you. And, we told a story a couple of months ago about KB Homes, or one of them in Texas, selling an entire community, 110 or 120 homes, to a pension fund out of New York, when they built them originally to sell as, primary homes or what have you. And they ended up selling them to an investment fund. So it's all about the money. And I don't think that lumber prices going down foreshadows anything with regards to the housing market, because most of the homes selling are existing homes, right? They're not new construction properties, and therefore the price of lumber has very little effect on existing properties. The only thing it changes is if you're remodeling your home, or somebody's remodeling their home to get ready to sell it. And that only benefits the person in that case that's doing that remodel, right? Because now it's less expensive to do it. But Josh, anything you want to throw on that one?
No, other than to throw a little fire on the last thing you said. I was talking to my contractor today, and we were looking at a property in Garden Grove. I said, hey, if we bought this, it would be perfect to add 400, 500 square feet, put a master and a bonus room off the back of it. And he said, well, that sounds awesome, but I just did a 500 square foot addition on a home in Riverside County, and he paid $52,000 for the lumber for the framing. He says, I've done entire additions for $52,000. He says,
Wow.
I would not take on any project right now that involves an addition. So we had this exact conversation. This is from a contractor who's in the business and sees it all day, every day, and is buying lumber. He said exactly what Jeb is saying. A lot of Home Depot, Lowe's, they hedged. So they've bought commitments at these really high prices. So it's going to be a while for the prices work through the system,
Yeah,
and it might
exactly.
be 6 or 12 months. So even though in the futures market prices are down a third from where they were 2-3 weeks ago, it's going to take a while for it to hit the street, but it doesn't have anything to do with home values.
No, and I think that's something you touched on there that we haven't really talked about is the Lowe's and the Home Depots of the world and wherever you are, the lumber supply companies or building supply companies for that matter, they buy their lumber on futures, right? And so as the price went up, they paid whatever that amount was for wood, for lumber, and maybe for a couple of months out because they thought it might even go higher. So it's like airplanes buying fuel. They load up on this stuff at a certain price to hedge themselves against it going any further. Well, when it goes down, they've already paid X amount for it. Guess what? That X amount is still going to get passed on to the consumer, right? They're not going to just take it in the shorts and just cut the price to whatever the new price is. They're still going to unload it at the price that they paid for it. Maybe it'll lower a little bit, but I was talking to a buddy that and he said that I think that the price in Home Depot and Lowe's had dropped by a penny or something, even as it went down from 1700 down to like 12 or 1300 at the time. The Home Depots and the Lowe's had dropped it a cent. So with that said, it's going to be a while before you really see the impact in the cost of changing. But that gets me thinking about inflation, Josh, right? So everybody looks at stuff like lumber and goes, well, it's inflation, right? I mean, prices are going to continue to go. Well, they're already coming down. And so, while the Fed says this is transitory, it's just because of what we're going through at the moment. Stuff like that is basically confirms exactly what they're saying. We could do a whole live on that, which, nobody's interested in hearing that, but I just wanted to throw that out there.
And the lumber is probably one of the best examples, other than there was a speculative element. Once it starts going, there are investors that don't give a shit about lumber. But when they see a market making a technical move like that, they'll pile in and make money on that trade. You all remember, well, I shouldn't say that. You guys are younger than at least me, and Jeb's just a little bit older than you guys. But in trading places, when they wanted to corner the market on orange juice, they had no interest in orange juice. They were just trying to corner a market to make money. So a lot of these things have been exacerbated by traders trying to make money. But when you look, the biggest issue is all of these figures were depressed last year, and now they're artificially high due to supply chain issues. Of course, year over year numbers are going to look awful. If we go back 2 years or 3 years and smooth that over that time, we're right on trend with inflation at or below, most likely below 2%. And there's nothing happening right now that should be alarming to anyone.
All right, there you go. I think that's good. Let's see here. So Ray says we should be watching the NBA playoffs. I think that's part of the problem why the internet's so bad is probably because there's streaming going on of playoffs and that sort of thing happening. So, and trying to throw HD video and all of this stuff on the internet connection at once. So, there's some playoffs happening in the background.
Unless Mr. Miyagi rolls in and heals Kawhi's knee, I ain't watching anything tonight.
There you go. Let's see here. Freddie. Oh, actually, we got a super chat, which I'll go to real quick here. Sorry, Freddie. Premature. Gone viral. Will U.S. ever go negative interest rates? Josh, I'm going to throw that one to you.
I would say there would be incredibly strong resistance to it. So it's unlikely, but absolutely not impossible. really smart people, much smarter than I am when it comes down to this. I've seen some say and make the case that it will happen, and I've seen others say it won't. But they can go a lot lower. They can go, when we talk about federal funds, what are we right now? Some of they're pinned between 0.25%. But when you talk about actual Treasury yields, I don't think you will see them go negative. And in the context of what we're talking about right now, mortgage rates could never go negative because there's always a profit needed there. So to get a mortgage rate to be at 0 or negative, someone to loan you money to buy a house, which involves risk of default and loss to the investor, is just not going to happen, because even if they were able to borrow at a negative, they're going to require enough of a risk premium for that rates are going to be above 0%. So we've had this question before, and we've talked it through. What is the hypothetical low? Somewhere between 1.5% probably on a mortgage. I know back in 2013 and 2014, people were having this conversation. No, it's probably about 2.5% on a 30-year fixed, and we've obviously proven that that's not correct. We've had 0-point loans at 2.5, 2 3/8 for a few days. That's about the low that we've seen, and I can absolutely make a case for them going lower and lenders still being able to make money. So my guess would be somewhere between 1.5%, and I think before this all resolves itself, when I say this long super cycle of excess government debt and really low interest rates, before that gets resolved, we're probably going to get to that level, and we'll find out what the theoretical low is.
All right, there you go. Let's see here. Freddie saying, sorry, I'm back to you, Freddie. Looking to refinance from FHA to conventional. House value's gone up so much where I'm at the 20% equity to remove PI. So basically, I skipped words there. I read what I wanted to in that. Now has 20% equity. So congrats. That's awesome. A lot of people are in that position. That's why when people crap on FHA loans, it drives me nuts, because people like you are able to get into a property, put 3.5% down. Now you have the equity to be able to remove that PMI, get into a conventional loan, and now you're in a great spot. Now, I mean, that's awesome, and that's a reason that if you're hesitant to use FHA for some of these reasons, it doesn't necessarily mean you're going to get the equity overnight or in a short period of time, but the chances are, as home values continue to appreciate, you're probably going to be in a position where you're able to remove that. What's happening there? You got
there's one person in the group who's seen the movie. Randy Watson said, did he just reference Trading Places? Mortimer!
That's one guy.
Are you saying you don't remember Trading Places?
I don't. Dude, I'm not a movie guy. Like, I don't watch movies. I'm in bed by 8 o'clock, Josh.
This guy.
Who has time to watch movies? All right, 2-part question. What are the average appraisal times you're seeing in California? Josh, average appraisal time. Go.
If you don't want to pay a rush, probably 2 to 3 weeks. With a rush fee, 7 to 10 days.
All right. How do appraisers determine price for non-community tract homes, custom homes, homes on acreage? Does number of bids play a factor on appraisal? So they go out and they try to find, again, they still use the comparable sales approach. So they're going out trying to find comparable properties, even though it's not a tract home, even though it's not exactly the same. They're going to try to find homes that are similar in size, square footage, lot size, year built, as much as they can in common. Do bids play a part? Yes and no. They're not necessarily reflected in the value per se, but there's an area on appraisals where appraisers can put their comments. And what my understanding of this, and Josh, you might be able to shed some light if I'm incorrect here, is that that's where they're putting information on bids, right? That's where they're informing whoever's looking at that appraisal that, hey, there were 25 offers, the bids range from this to this, and the market is appreciating at X in this area per month, and so they can give that sort of information. But as far as actually, where they put the information on the appraisal itself and they're comparing properties, I don't think there's anything with regards to the bids that is actually going in that area. I think it's all going into the comment section and it's reflected in the value, but it's shown in a different way. Josh? right,
Yeah,
wrong?
it's not
Yeah.
directly on there. And then the second piece that I would say, like when we're talking to realtors, I always ask the listing agent to show up to the appraisal. Sometimes they'll have an assistant go out. Sometimes they'll let another person let the person in the property, or they, hey, there's a lockbox, go yourself. We want them to go out there. We want to give them the first page of every offer they have. If that's 60 pages, print them 60 pages and hand it to them. If you have the time, effort, and ability, go through everything that's sold in the last 6 months and print just a one line and in chronological order so you can see that price trend, because an appraiser can do a time adjustment. But Ricky, back to your question, how do they do it? It's like if we're here in Huntington Beach, we can't really go outside of about a half mile on homes because there's so many homes in that area. There are good comps, much more likely than the further we get away. You can be out in a rural area 8, 10, 12 miles away, and it can be very hard to find a similar sized home. You can have the most recent sales 2,000 square feet and your subject is 4,000. So they have a lot more leeway with their adjustments. But again, their appraisal practices tell them find the most similar recent sales and adjust for time, amenities, size, quality. Just that's like where we get into it with appraisers is, I had one, the infamous one that we talked about 6 months ago, where the appraisal came in $50,000 low, and they said, well, yours backs to the freeway. We have to use that. We have to use the most recent comp that sold backing to the freeway. Well, that home had been remodeled 10 years before by a grandmother and grandfather. Ours was a brand new remodel that looks like it came off of HGTV. Yes, they're both nice homes that were recently remodeled, but a buyer is going to pay a premium for it. So the adjustments are really subjective, and that's where we have to dig in and say, is this reasonable? Is it consistent across all the comparable sales? And the less comparables there are, the more difficult it is for the appraiser to do their job.
There you go. A couple super chats here. Jennifer, is it worse? It is worse when VA is crapped on. I agree with you on that. Lots of questions. Let Josh cherry pick. So I'm not sure what the let Josh cherry pick is, unless there's questions related to something that you want to throw out there with regards to VA. Are you?
No, I don't. I'm not sure where she's going with it. But the funny thing is, anyone that says anything bad about VA, the only one that could have a negative opinion of a VA loan is the possibility in the current market is a seller. A seller is concerned that you have an escape clause that says if the appraisal doesn't come in, that the veteran cannot be compelled to complete the transaction. And with zero down, most veterans come in with zero down and they don't have a bunch of money behind them to make up a shortage. So from a seller's perspective, there can be a downside to it. But the VA loan, everyone should be so lucky to be able to qualify for a VA loan. Absolute best rates, low closing costs, no monthly mortgage insurance, and zero down payment required. And the crazy thing is they have the lowest default rates of any loan. The program is clearly doing something right. We should be looking at that of saying, how do we create something similar that doesn't require being a veteran? We put some tight constraints on it, but the down payment is not the thing that is predictive of lower default rates, obviously as proven by VA loans.
No, that exactly. And if to follow up, Jennifer, if you have questions about VA, put them in there. We'll get them for you for sure. And thanks for checking fools in the chat. Jay Wynn, just have to mention how awesome Josh is. He was incredibly responsive and informative when responding to my email regarding low desktop appraisal. Thanks, Josh. Here's a little money for your beer. So, Josh, $10 that's not making it to you, that's staying with me.
I'm gonna have to set up like a PayPal account and put it down here on the bottom so these people can know how to direct it directly to me and away from you.
I'll delete it. But thanks, Jay Wynn, for the contribution there. Let's see here. Aware's got a really profound question. Did Tito Ortiz exiting his position affect the housing market in Huntington Beach? I'm going to go out on a limb, not 100% sure, and say no. It didn't really do much. He lasted longer than I thought. He started getting hate right from the beginning, and I'm surprised he lasted that long. And that was like a month. Let's see here. I'm lost where I was, Josh. So just pick
hold
anywhere.
on. I got a good one to cue you up here.
All right, here we
Neil and Terry Fuchs say, do you have any strategies on coming up with a selling price? Comparable home prices are all over the place where I live in Washington State. So what do you do, Jeb, in a situation where comps aren't really saying this is the number?
What I would tell you is, well, for one, you need a professional, right? A real estate professional, because that agent is hopefully going to be able to guide you. But even then, as a seller, you should have an idea of what your home is worth. And sites like Zillow and the Redfins and those guys are, quite frankly, not very accurate. It's really easy to manipulate that data and change things. And I've talked about that in other videos. But you need to try to find comparable homes. I mean, that's what it boils down to. And if you don't have the ability to do that through sites like Zillow and Redfin, because the information's out there at this point with regards to the data, it's just a matter of, can you read it and can you decipher it? And I think that's probably the toughest part for somebody that doesn't do this on the daily basis. But that's where hiring a professional in your market, and again, this is a conversation that you can have with an agent without actually hiring them, right? I mean, I go on many, many listing appointments that I'm not hired on, where I discuss what I think the home is worth. And that's something that you should probably do as well. I mean, as you're starting to enter that, the thoughts of potentially selling your home, I would say find a pro. I know several in the Washington area, depending on where you're located, that I can refer you to, and you can get a really good idea of maybe talk to 2 or 3 people and see what they say. It's always good to compare some of these people as well, right? Because I mean, I will tell you, going on a listing appointment where somebody's been in before me or coming in after me, we're going to have some sort, rarely ever are 2 agents going to come in and say, this is what I think the house is worth, and be exactly the same, especially in the market that we're in right now. And it's somewhat of a guess, more so than ever, in this environment, because people are doing things that I've never seen in my career. People are willing to go above and beyond, for whatever reason it is. And you never know why somebody might be buying a particular house and what they're willing to do in order to get in that home. And so those are all things that you can't really factor in. But what you can do is say, hey, look, this is the fundamentals. This is what, I think is fair and reasonable. This is, fair and reasonable to me, and price it somewhere in that area. And there's a really good chance, if it's right, it's probably going to go above that. But outside of that, I don't really have a hard, fast way to say, hey, type in your property address and you're going to get your value, especially if you're in an area that doesn't have a lot of comparables. You need more of a professional, guiding you in the process and helping you out. All right.
Jeb, the thing that I like to tell people, the good news about the current market is it's nearly impossible to underprice your home. It's an auction process. The market's going to tell you what the home is worth. You see it as a strategy. Agents don't even try to price it right. They put it 50 or 100 grand below the last sale and go, all right, tell me where we're at. Jeb, I wanted to throw this one up here.
Yep.
Not to toot my horn, but our team.
This is exactly what you're doing.
No. So yes, the guys over at Buywise Mortgage are superb. Too bad I live in Texas. They were still able to link me with someone to help me refinance my VA loan out of forbearance. So she had left a message for me before I even got the message. She had connected with Russell, and Russell got her connected with Randy Tikel, our buddy out there in Texas. Yep. Awesome loan guy, a good guy. I think he has a good number. Were the videos, Jeb, that you saw of his, were they on YouTube or were they out on his personal channel?
I think personal. Yeah. I don't know about that. Yeah. And I just know that he's got some personal family videos that I've seen. Outside of that, I don't know.
Long way of saying Randy's a good guy. He can help you in Texas, but we have other people in Texas, and we've got people across the country. Wherever you are, we have good people that can help you. The biggest thing that from a mortgage perspective, what I try to do is keep people out of call centers. Call centers are the McDonald's of mortgages. They train young kids that don't know much to do the bare minimum to get a loan closed, and they give very average terms for that. So much of what we get is someone pushed the easy button. They were going to push button, get mortgage, or when banks compete, you win. And they got bombarded with phone calls. They got bad advice from a kid in a call center, and we're getting led somewhere they didn't need to go. So if you have questions, just because Jeb and I are in California, he has an awesome network of realtors around the country, and I have the same on the loan side. We can get you with a true expert that can help you.
No, absolutely. And again, we'll post that link at the end. There's that. You go in the description and click on, get me a referral, and that will connect you as well. Logical Thinker has a good question here. He has a logical question. Why should the purchase price be disclosed to the appraiser? Wouldn't it be more accurate of basically, wouldn't it be a more accurate appraisal if it wasn't provided? Josh, thoughts on that?
It would be a lower appraisal because to a degree they are trying to work their way to the answer, work their way into the answer with that. Yeah, I wouldn't want to live in that world. We have a hard enough time when they do know what the value is, and an appraiser is not the person there. I'm trying to think of the best way to say it. An appraiser doesn't know what the value is any more than you or I do. The market determines the value. What's the definition, Jeb, of market value? It's what two educated consumers in an open marketplace are willing to buy and sell for.
Right.
So we're seeing that regularly in this market, and yet we have appraisers coming in and going, no, I know what the value is. So it's an imperfect system. I don't have all the answers of how to fix it. I wouldn't want to live in a world where they didn't have a copy of the contract and know where we needed to be.
But here's what I will say to that logical thing, is logical thinker, is that, oftentimes people are going through a divorce or a home is transferred, the values, a property's transferred to an heir or somebody in the family or whatever it is, and an appraisal needs to be done. And oftentimes, appraisers get the value pretty accurate. Sometimes now, what they don't factor in this environment, in those situations, is the multiple offers and all of that stuff. But they do the same thing. They look at comparable sales. They look at upgrades on the property, condition of the property, size, all of that good stuff, and they come up with a value of what the home is worth. So to say that they would be completely off without having the number, I don't think is accurate. But in a market right now where things are moving so quickly, month over month appreciation is something that is real. Having that number is, it helps justify what they're trying to accomplish, because they don't know that there's 10, 20 people that were willing to pay X amount above the asking price. I mean, there's stories of people in Sacramento, where there's 120 offers on a house, and in Washington, D.C., 100 cash offers and that sort of thing. I mean, that is really what dictates the value of a home, more so than in any other comparable sell, regardless of the definition of how appraisals are, computed or what have you. So that's it's a rabbit hole, right? I think there's logical explanations or conversation that can be had on either side of that. This is a question. Go ahead.
You're just pandering. You're saying that logical. So you wanted to make logical thinker think you were on his or her wavelength.
You see that?
Yeah.
Sales, man. Sales.
NLP. You're using NLP over there.
You repeat what they said back to them. And I just saw his name, so I just kept repeating it. Should I borrow from my 401k to keep mortgage payments down? So Josh, maybe, you can answer that question, but thoughts on just borrowing from a 401k initially, maybe if you don't even have the down?
I don't hate it. If you don't have the down, I hate it less than this situation. You're going to repay yourself with the 401k loan. You're not taking a withdrawal. If you did, you'd be taxed on it. There'd be some penalties. So if you're taking a loan from it, and let's just say if you were taking a withdrawal and paying taxes and penalties, then I absolutely hate it. So from that perspective, if it's a loan, you're going to be repaying yourself. So there's going to be money taken out of your paycheck, and you may say, well, I'll just decrease my 401k contributions. It's all tied in together. You're not saving any money by doing it. Get the best loan that you can with the amount of money you have available, unless there's a huge difference that would make it worth putting the bigger down. I don't even know what that would be. If we were going from 10% to 20% down, you didn't have mortgage insurance, and you could run the numbers and then justify the amount that you would pay for mortgage insurance going back to the repayment on it. But other things being equal, I don't think it's worth it to subsidize the payment with pulling money from your 401k. Now, Jeb mentioned a really good point that if you're looking to buy a $300,000 first-time home, and we need 3.5%, so we need $10,500 to get you into that property, and you have it in your 401k, and you can borrow it and pay it back. Definitely better than remaining a renter while homes go up $10,000, $15,000, $20,000 a year.
There you go. Morad has a question. If I make an offer on, say, 3 homes and accepted on 2, can I pull out on 1 with 0 obligation? In the state of California, yes. Other states, I'm assuming it kind of works the same way. I mean, you're not in escrow. You don't have a binding contract per se until the money's actually in escrow and getting escrow open, at least here in the state of California. I mean, you have a binding contract once there's signatures there, but you have to perform on that contract within a certain period of time, or it can be canceled. So, in theory here, yeah, you could cancel on that. Other states, I'm not 1,000% sure. But I would assume it works in a similar manner for the most part.
Hey, Jeb, we've got Randy Watson has had a question here for a while. I think he actually asked twice. Let's see if we can work it in. So Randy Watson says, I want to buy a new home, $55,000 equity in my current $80,000 home. Should I sell the current home or keep as a rental property? Credit 710, combined income $145,000 a year, have maintenance skills to care for a rental. And the part that I missed when I read it the first time is $80,000 value. So really you owe $25,000 on an $80,000 home. So by all means, I don't see a reason to sell it. I mean, it's probably going to cash flow pretty well with only owing $25,000. You have the ability to maintain it. If you feel like you have the ability to manage it, or you have a property manager that you would trust, it's a nice asset to have, unless you had something else that you would do. Because at $80,000 home, you sell it and you have 5 or 6% selling costs. So that's $4,000 or $5,000. Now you're down to $75,000. You'd walk with about $50,000. What else would you do with that $50,000? I think keeping the home and getting it paid off and having it be a nice source of cash flow in retirement is a pretty good option.
Yeah, and I guess the other question I would ask is, do you have money for a down payment on another property without having to sell that? And so if you do, and you can rent that property out in cash flow like it is, then I'd say, why sell it? Sounds like you're in a good position to keep it. I encourage clients all the time, if they're in a position to keep their primary home or whatever home they're leaving to go buy another home, I'm trying to get them to keep the property if possible. Now, that might sound crazy. A real estate agent would tell people to keep their property, but if you have your client's best interest in mind, you're trying to help them, and they remember things like that. And so oftentimes people aren't in a position to keep their homes because they need the equity from that property to buy the next one or what have you. But I think if you're in a position, you understand the rental market, you understand the risk and all of that good stuff, it could end up long term being a really good situation. Let's see here.
I got a good one here, Jeb.
All right.
Judy's Workshop, not Judy, but Judy's Workshop would like to know. Question: my offer was accepted with an FHA. Can the seller get out of the contract if the appraisal comes back lower?
Yeah, I mean, it depends on what you agreed on or what was written into the original contract with regards to, the appraisal and what have you. But assume it's just a typical purchase agreement, and there were no changes with regards to the appraisal and paying overages and all that good stuff. In theory, yes, they could back out, right? So if the appraisal came in less, let's say you're buying a $100,000 home, the appraisal comes in at $90,000. You say, I'm not paying $100,000. The home's only worth $90,000. I want you, Mr. Seller, to reduce the price to $90,000. The seller can say, no, not willing to do that. And at that point, that doesn't mean the deal is dead there. It's a negotiation. It's you trying to figure out, okay, will the seller pay anything, or are we both stuck where we are? Now, if you're both stuck and you can't, come to any sort of agreement or what have you, then the deal is going to die. But, there has to be paperwork that cancels that agreement. But in theory, yes, they can back out if it does not appraise.
Got another good one here for you, Jeb. I'm assuming she's in, this would be Minnesota. This is North Star. I was going to say Texas, but that would be a Lone Star. So North Star. So I think she's in Minnesota, but I could be wrong. If an agent writes a house offer one time, are you automatically in contract with that agent or agency? So she's essentially asking, if someone writes an offer for me on a home, am I obligated to continue my home buying search and work with that person?
In the state of California, unless you've signed a buyer broker agreement with that agent, you're not tied to that agent. And so if it's one property, you could change agents and move forward with a different agent on another property. Shouldn't be any issue there. At least that's how it works in California. You got to make sure that's how it works in your state. Now, what I will say is if you write an offer on a property, for example, and that deal doesn't happen for whatever reason, and then you decide later on, you know what, I'm going to write another offer on that property. Basically, I mean, I don't know how the law is actually written, but you basically have to use the same agent again if you're writing something on that property, because there was some sort of agreement that you had with that agent initially in writing that offer. That's actually a really good question. I don't I don't know how that works, Josh, after I said it. But I do think that you're tied to that agent for that property if you wrote an offer on that property. If you change
it
your
would
mind
go
in the
back
future,
to procuring cause. They
Yeah.
took you to the home, they showed you the home, they wrote an offer. You can't pretend as though you would have known and been aware of the property without them. It'd be pretty hard for them to get
Yeah,
aced out of the transaction.
but I do know that you could go to a property with agent A, see that property and decide, you know what, I do want to write an offer on it, but I want to write it with agent B. And if there's not an agreement there, they can, in theory, change their mind. I've had that happen. I've had to talk to legal about it in the past, and that happened. But I think if you actually physically write an offer, then you're associated with that agent for that property. Now, if there's a buyer broker agreement, as I mentioned a moment ago, then you're tied for the specificity,
Something, one of those things.
You're tied to the agent for as long as that contract states. So, all right.
So Dar was here back with another question. Under contract on a home built in 1885, how much of the appraisal is based on the home's age? Not much, other than, let's say it was surrounded by homes built in 1985. They wouldn't be able to use those homes. What are you doing, bro?
I accidentally hit something.
Are you new? Yeah, you don't know how to use the system?
For first night. There you go.
So the only portion of it is, again, if it's surrounded by homes built in 1985, they're not going to be able to use those homes. They're not comparable to that. So they may use some of them, but there is at least going to need to be a comparable of somewhere around that time frame. So let's say you had an 1885 farmhouse. It was built on a farm in 1885, and now in 20 years ago, tract homes were built all around it. It can be difficult, but they need to at least have a comp or two in there of a similar home from the same time frame.
All right, there you go. All right, here's a question. Nicholas Alderman, do you believe 2020 will have even higher demand with the anticipation of the Fed increasing rates in 2023? Again, Nicholas, it's one of those questions that's like the crystal ball question. I don't think demand is going to be as high as it is next year as it is right now. And I don't really know why I think that, to be completely honest. I think that you'll probably, now that the vaccination, is somewhat under control with the quote unquote pandemic, and states like California fully opened up. I think we were probably the last one to fully open up at this point. I think you're going to have people, start to put homes on the market. So I think inventory is probably going to increase. But I don't really know. I mean, I think demand's probably going to stay there. So I don't really know where things are going to be in 2022, right? I mean, we're not even halfway through 2021 at the moment. We're already talking about 2022. There's plenty of YouTubers out there that tells you that the market's going to crash this year. So
it already is. I saw the headlines
crashing
on a couple of titles this week.
Yeah. So, I mean, it's too hard to predict. I would tell you, if you're in a position to buy now, as we've stated, it's probably going to be a better time now than this time next year. But that, I don't know if that means, I don't think home prices are going to be any less. I just don't know if demand is going to be as crazy. So less demand just means that less craziness when actually making an offer on a property. It doesn't necessarily mean home values are going to come down.
So, and Nicholas, the good news is the Fed in their press conference today and their press release said they're thinking of actually raising maybe in 2022 versus 2023. It's important to remember that the Fed does not set interest rates. The bond markets do. They set the overnight lending rates that when banks lend to one another, but they don't set the rates directly. And generally, rates will improve as they start an increasing cycle. There's a lag to it, and the reason for that is markets abhor inflation. So you see the news today, we're all in a panic today about the non-existent inflation that everyone's worried about. Fed raising rates will generally put the stop to that, and markets like that, which will lead to lower mortgage rates. So if you've watched us here, you know I'm telling you rates are not going much higher from here. They could go higher, not going much higher, and the long-term downtrend is intact, and we're going to see better rates ahead. Might be 2 years, might be 5 years, but they're going lower.
There you go. Usama. I'm DC area thinking about selling my house, but want to wait 6 months to a year. I forgot to say thank you for the super chat. Appreciate it. Do you think I should sell immediately with the hot market? We've talked about this. Sell and do what? What are you going to do with the 300? You go on to say that you purchased for 200, you could get around 500. So you're going to get $300,000 in equity. What are you going to do with that money? You're going to buy another property? Okay, can you find a property in this market? That's the problem. I know that DC area is a hot market. North Virginia, DC, parts around Maryland, it's a very, very hot housing market. So chances are, if you're going to buy something else, you're going to have issues there. I think you just need to have a plan. Everybody, is trying to time the market. And I would say, have a plan, try to figure out what it is you're trying to accomplish and do that. And I realize that's a really vague answer, but it's hard to give you any advice without really knowing what it is you're trying to accomplish there. So, Gerald, hold on one sec. Gerald, $10. Thanks for the advice on the homeowner's insurance question earlier. Appreciate it, Gerald.
That's beer right there. That's beer.
You can't drink.
Hey, my birthday's next week. I'm off until my birthday, and then we're starting up.
All right, there it is.
All right. Hey, we got a good one here. Freddie says, looking to refinance. My credit score was hit since I purchased back in November. It was high 700s, now low 700s. Will this affect getting a conventional interest rate? Current FHA rate of 2.6%. So the big thing we want to see, FHA purchase in November with 3.5% down. Let's say it could have gone up 10% since then and you've paid it down a little. It's going to be unlikely that you have a full 20% equity in there by now. It's possible, but we'd want to look at it. But the specific question on credit score and how it impacts interest rate, on a conventional loan, anything 740 and above is the highest tier. So if you're, say, low 700, say it's between 700 and 719, you'll be a little bit worse than the best interest rates, but still pretty good. If we can get it to 720 to 739, better, and then 740 and above, best still. So I would love to get a look at the credit report. If I'm doing your loan, I'm going to look at the credit report and see what's impacting the scores, what changed since that time, what can we possibly do to get you to a 720 or a 740. So I see you posted here that you're in SoCal. If you want us to take a look at it, if you want us to run through the credit and see what we could possibly do to get you up to that 740 level and get the best rates available, be happy to do it. Be happy to walk through the numbers of in terms of what we think it would appraise for and see if getting rid of mortgage insurance is a possibility right now.
All right. Let's see here. Jennifer goes into comments, say, can we help Ted Bundy out? Several questions. I think you meant Al Bundy. Ted Bundy.
Ted Bundy,
I think, is in prison and or dead.
I've seen too many shows about that man. I don't want to help him at all.
I know Al had some questions earlier. Al is always here asking questions. I'm just going to address some really, let's see here. Let's see here. We'll address one. So what should buyers worry about with the NHD? So in the state of California, there's something called an NHD. It's a natural hazard disclosure. It's a disclosure that basically shows you where you are, the house you're purchasing, where it's located versus natural hazards. Natural hazards might be things like a flood zone. It might be things like earthquake fault lines. It might be things like nuclear power sources, that sort of thing. And so what should you worry about on them? being in Southern California, I mean, really nothing, because most of these homes fall on some sort of fault line or near a fault line or what have you. But I mean, pay attention to it, right? I mean, if you weren't aware that the property was in a flood zone, that's something that you need to know. If you weren't aware that there was like a nuclear power source, power plant nearby, or whatever it is that it states, and that puts off, some people believe that those things put off radiation and that sort of thing. You just need to know what you're near. So I don't think there's a right or wrong answer to answering these. I mean, most often I see these things come back and it's a yes or no, and they're filled out by a company. The seller's not filling these out. There's companies that do these and are in charge of filling these the information out. And so, you just want to make sure that the information there you're okay with. Outside of that, there's nothing you can do to change it. You can't pick the house up and move it. And so you just got to be okay with the location of the property. So hopefully that is helpful for you there, Al. Let's see here. We got a lot of questions coming in. I'm trying to spread these out.
I got a good one here,
Yep.
and it actually comes up fairly often. Jonathan
Yep.
Garcia says, "Good evening, guys. Thanks for everything. Is it a good idea to go through underwriting before having an offer accepted? Currently going through that process. I wonder if it'll make closing take less time." So as an example, Jeb got an offer accepted for a buyer last night. We submitted today. We expect we'll have an approval on Friday. A slow lender, maybe that takes a week. So it can give you an advantage if you've gone through underwriting. So the real question is, are there any big questions there? We don't send a file through underwriting before we get a property unless we have big questions about the borrower's approvability. So does it happen? Yeah, about once or twice a year. But I have an underwriter on staff. I've done this for 26 years. I know whether you qualify or not. So underwriting is largely a formality. And with the majority of our lenders, it's 48 hours or less. So we're going to have that answer pretty early. If you're concerned, if it makes you nervous, if your lender thinks it's a good idea, or if they're super slow in underwriting, there's zero harm in doing it. It's, for the most part, most situations, it's not necessary.
All right, there you go. Someone earlier was asking about appraisals. James Waters just has a comment here, or I guess a question at the end. Just bought a house in Gainesville, Florida for $275. Appraisal came back at $305, so $30,000 in equity there. Can I see a jump in the next few years for my house value? Possibly, yeah. I mean, Florida is one of those hot markets. We talked about it earlier. People are continuing to move there. The state, I forget what the population. I read a number recently and I forget it. And when I read it, I was like, whoa, like that's big. And it's something like, the population had doubled or something crazy, whatever it was I read. And I don't remember it exactly, but people are going to continue to migrate to Florida for multiple reasons. And Gainesville, I know, is a desirable area. And so chances are, it's going to appreciate. But again, it comes down to supply and demand, right? Supply stays low, demand stays high. You're likely to see future appreciation. If that changes, then that's where you'll likely see a change in how your home appreciates. Now, I saw a question here. We got a couple coming from local people here too in Orange County that I wanted to touch on, some regulars. But Josh, you can find one if you see one.
Some things we actually know about. This is a quick one here. Jakir Hussein says, "Want to buy my second home in Fairfax, Virginia, around $425,000. What was the time to buy my second home? I want a down payment of 10%. Also, what's the best way to buy my second home?" So we didn't, in the question, we didn't know how long ago you bought your home and how much you put down. How much equity do you have in it? So you're saying, what was the time to buy your second home? I think you're asking how long you need to wait. Anything after 6 months, you should be okay. You signed an occupancy affidavit with the previous purchase saying, hey, I'm going to occupy the property as my primary residence within 60 days, but you didn't promise to live there forever. After 6 months, we're pretty good. After 12 months, we're absolutely good. So the best way to buy your second home, if you're going to own or occupy, your 10% down is plenty. It just comes down to what will your current home rent for, And you may be, you may be saying literally a second home. If you want to occupy both of them, if you want to have your primary and a vacation home, you need to qualify for both of those payments from a debt to income perspective. Quick plug, Jeb just did another video on debt to income and how to calculate it and figure all that out. So it's a good one to watch if you have that question. But this one, really, we can go down a rabbit hole on this question because there's a lot of specifics. Reach out. We have an excellent lender in Virginia that has extreme knowledge on VA stuff and can guide you down exactly what you need to do.
All right, so there's a couple questions here I'm going to go through pretty quickly, Josh. Surf City HB, can I make offers on multiple homes at the same time in hopes of one being accepted? Absolutely. You just need to make sure you obviously have an agent on board that's willing to do it. Some agents may not feel comfortable doing it because if multiple offers get accepted, then they're kind of in a position where, they've got to tell the other agent that you're not moving forward or whatever, relationships come into play, what have you. I'm completely okay doing it, especially in the environment that we're in now. So I think most agents probably are, but yeah, nothing wrong with doing it in this market just because it's competitive. Another quick one here, North Star, why can't I have more than one buyer's agent? Agents don't have time these days. In theory, you can, but you need to have an agent that's okay being one of your buyer's agents, like having, multiple boyfriends, right? As long as the boyfriend's cool, you're okay, right? But if one's not cool with it, then it's hard to have multiple. Same thing here. I wouldn't be one of several buyer's agents, not in this market. Never, for that matter, but definitely not in this market. Too much time, too much effort is being put in to not be the sole person. And you had asked a question a little bit ago too that you had signed something, maybe saying that you were affiliated with a broker as part of seeing that property, and it was a 6-month agreement, and you didn't know that you had signed it. Unfortunately, you signed it, whether you knew what you signed or not. Now, I'm the kind of agent that, if I've never done a buyer broker agreement in my life, been in the business 18 years, never had anybody sign one, but that's how I do business. A lot of agents do them. But I will tell you, if I have an agent, even if I have a listing, for example, right, a listing contract, the seller says, I've changed my mind. I don't want to work with you, don't like working with you, whatever. I'm going to let the person out of the contract. Why would I keep somebody in contract that doesn't want to do business with me? It makes my life stressful. There's too much emotion coming from that side. How could you actually have a peaceful negotiation and do the right thing for everyone if the person doesn't want to work with you? So I would tell you, if you don't want to work with that agent, have a conversation. Just reach out and tell them, hey, look, this is the situation I'm in. I don't feel like you're a good fit, and see if they'll cancel it. If they won't, go to the broker, have that conversation. Somebody's going to let you out of it in most cases. They're not going to keep you tied into a deal that you shouldn't be. And if they are, then that's the person that you didn't want. You shouldn't be working with that person to start with. So anyway, all right. Rabbit hole there, Josh.
Yeah, and I would say, so when we were talking about it before about the buyer's brokers agreement, if anyone asks you to sign a buyer broker agreement, I would just refuse and probably find a new agent. If I have to get you to sign an agreement to continue working with me, it means I'm not super confident in my ability to build rapport and confidence in you from your side that I'm going to represent you well. And then the last thing I would say is, why can't you have more than one buyer's agent? If you feel like you need more than one, you have a shitty agent. The only reason why I could think why I would want more than one agent is if I was looking at 2 geographically diverse areas. And for us in Southern California, it doesn't have to be all that far away. Jeb, we have a client that you were going to refer someone to down in San Clemente, which was 40, 50 miles away. And she referred you someone up in Buena Park, which again, 40, 50 miles away from her. So if you don't have geographic expertise, if you aren't in the area to help someone, I totally get having multiple agents, and I don't think either one of those boyfriends would be unhappy if you explained to them why you were doing that. But yeah, just be open with everyone. And if you're just looking in a small geographic area, keep looking until you feel like someone, you says agents don't have time these days. Shitty agents don't have time these days. They get paid a lot of money. Real estate commissions are well earned and well deserved, but that's a nice chunk of money. They need to earn it from you. And if they don't have the time, they need to either have a team that can service you that way, or find someone that does. There are a lot of good, we talk about this every week, full-blown 80-20, if not 95-5. Tons of realtors, 20% at best, are good at their job and being able to do a good job for you. So again, because there's so many realtors, that means there should be plenty of good ones. You just have to look further.
Got it. A couple questions here regarding VA. Jakir put a comment down there. You can reach out to Josh, get connected that way about VA. Here's another one from Jesse. Lives in Oceanside, pays $1,400 a month for an apartment across from the beach with ocean views. Combined income, 130 grand. He's a veteran. Thank you for your service, Jesse. Is now the time to buy a home if they are still 600 Gs? I would tell you, what's your plan? What are you trying to accomplish? Are you going to rent forever? $1,400 a month's not a bad deal. But you're missing equity, right? You're missing that home ownership. Homeowners are have a 44 times greater net worth than those of renters because of home ownership, right? There's multiple reasons. We've talked about it before. But there's a lot to be said of being a homeowner. And I will tell you, if it's in your plan and it makes sense, then do it. If it doesn't, then, you got to do what's right for you. But if you have questions, you can also use that same email there that is just below yours and reach out if you have anything on VA. But while we're on VA, go ahead.
The thing that I would say, just close the loop here. So you live across the beach for $1,400. That's pretty attractive. So I could see why you wouldn't want to give that up. If you're looking at $600,000 homes and they go up 5% a year, that's $30,000 a year of equity that you are building. And that $600,000 price point, you're going to pay more than $1,000 down in principal. So in effect, you're saving $1,200 a month. So every year, you're going to be $40,000 to $45,000 wealthier as a homeowner. In exchange for that, you're going to pay more than $1,400 a month. So it just comes down to the question, do you like Oceanside? Are you going to be there long term? Are you stable? You make a good income. So I think you do, and you are. But if all those questions are yes, then I would absolutely buy a home. If you're uncertain about any of them, maybe you keep paying the lower rent and living right across from the beach.
All right. So Kathy has got a good question here. Agent keeps asking me to get a pre-approval from her friend who's a broker. Red flag. Well, here's the deal. I refer Josh.
We happen to be friends.
Yeah, to like 95% of my clients, right? If somebody comes in, they have somebody they know, like, trust, they're approved, whatever. That's great. Fantastic. If you don't have that person, I'm going to say, here, talk to my guy. And they may talk to my guy, which in this case is Josh, and they may talk to someone else. And if Josh doesn't get the business, then so be it. But the reason I refer Josh, I don't refer him because he's a friend. That helps out, but I refer him because he's knowledgeable. I know, effective communication. I know what he tells me up front is actually going to happen. Knock on wood, I'm not even going to say what I was going to say because I don't want to curse anything, but we've had a very good, solid history for a very, very long period of time. In fact, we close most deals before they're actually ready to close. So the fact that she's referring you to a friend, nothing wrong with that, but do your research and make sure that that person knows what they are doing, right? That they're not just having you use their friend because they're a friend. And keep in mind, it's illegal to get kickbacks, right? A mortgage broker cannot give a real estate agent anything, any commission, any fees or whatever. So I don't refer Josh because Josh gives me money. It's illegal. We don't do that. It's a RESPA violation, but again, refer him because he's the right person for the job. Now, just make sure that, that's why you're getting referred to that person. That's the only thing I would add to that, but it's not a red flag. All right. Some of these questions are softballs, and I just don't want to throw them your way. I'm trying to find you something that's actually.
I'm a good softball player, bro. I go yard every other at bat, at least.
Dude, you got a bum shoulder. You're not going anywhere.
Oh, come on.
All right, here's TA had another question. I thought that was it. Sorry, TA, we're gonna pull in that, retract.
Change my mind.
All right, here's one. Cap rate. How to find a cap rate for any level: city, state, national, heat maps, free service, paid service, or tables. Need a way to compare my deal analysis cap with a local number. So what's a cap rate? So a cap rate is for investment property. It's basically what you earn on the property versus what your payment is. What is that cap rate? And so I'm not aware of any sites that give you an exact cap rate. Each property is a little bit different in cap rates because rents are different in properties. Maintenance fees are different in properties. Cost to upkeep things are different. So I'm not aware of any site that provides that information. Now, when you're buying a property, in investment property, a lot of times on the MLS, they have that information. Well, most of the time they don't have the information because the person didn't put it in, but it's there and it should be there to help you figure out that cap rate. Josh, anything that you can add to that? Any insight?
No, it's tricky. And if you're a first-time investor, it can be more tricky if you don't know what to look for and what to do. So it would be great if there was a service. I'm not aware of one either. The biggest thing that I say is when you look at commercial listings, 9 times out of 10, to get an accurate cap rate, you need an accurate net operating income. And the pro formas that you get from most of these buildings are 100% bullshit. So if you haven't had experience owning a building and looking at those numbers, are going to be really hard to tell that they're inaccurate or just overly optimistic. So I don't have good advice. Just beware would be the advice.
Yeah, and depending on what type of property you're buying, I mean, it could be commercial, it could be residential. I mean, you can buy units, right? Units, multiple units have a cap rate of some sort. In that case, an agent can give you an idea of what those units would rent for, right? I mean, on the MLS in those scenarios, there's what the rents are now, and essentially what the rents should be in that market. Sometimes they match, sometimes they don't, just depending on where the tenant signed their lease and what have you. And so you've got to figure out what the cap rate would be if in this scenario versus a future scenario. So an agent can help you in that scenario. Commercial and that sort of thing's a whole different animal, just because of anchor tenancy and depending on what you're trying to accomplish and the class of the building and all of that stuff. So there's a lot going on there, and it's hard to do on your own. So just having maybe a pro on your side is the right step, and it shouldn't cost you anything to have somebody helping you out. All right, let's see, questions keep coming in. 101 likes. Thank you guys for being here. Been on an hour and 40 minutes or so. If you haven't hit the like button, it helps. So do that and help. How's that? Robert Bryce says, "Look at my question."
I found it. I just
direct,
found it.
Robert.
It took a while. He asked it a long time ago. We missed it.
All right, here we go. All right.
How do I find a home to be able to make a positive cash flow when prices are high and the good neighborhoods where I live have HOAs? I want to get into investing using the BRRR method. Robert, well, and I always forget the acronym, but it's buy, rehab, refinance, rent. Is that what it is?
Yeah. For the most part.
Okay. Yeah. So it's
and then you can add like a couple other R's on it too, and then it means other shit.
Cool.
So it's like,
that's over my head. It's an awesome strategy. I have one of our vendors, a genius marketer. He actually helps us with all of our email marketing to our clients. His secondary job that his wife runs it. He does all the marketing. His wife runs it. That's exactly what they do. They buy, rehab, refinance, and rent out all their properties. They are in Omaha, Nebraska. So everyone I know that's successfully doing this, if you're on Bigger Pockets, you're looking at that channel, no one's doing stuff like that in Southern California. No one's doing that in the Bay Area. No one's doing it in New York City. It's a great strategy. It's awesome, but you need to find a market where prices are low and rents are high. While our rents are not low in Southern California and in other high-priced markets, the values are so high, it's not going to work. It just doesn't work.
And to go back on what Josh says, I mean, if you can find property out there that's super inexpensive for whatever reason and do it, fantastic. But understand that, Southern California is probably, I mean, if one of the top 5, top 10 areas for investing and flipping property and that sort of thing. So the competition is fierce when it comes to trying to find property under market value. And that's really what you need to do in order to pull out that BRRRR strategy. All right, we got a couple of we had an agent watching here. Lana Realtor and investor is watching in front of her red. I can't even tell what that is. Let's see here. Danielle Tapia, do broker have extra charges? I'm not sure what the question is there. Is it is it broker lender, broker real estate agent? Maybe you can clarify there and we can answer that question for you. Let's see here. What you got, Josh? Seen anything?
Robert actually gave a follow-up here. I live south of Miami. I would bet that you could
Key
find
West, baby.
There you go. In Key West, you're also going to have problems with high prices. But I would bet that in Southern Florida, you can find some markets. You're not going to be near Miami. You're going to go more inland. But I would bet you could find. Now, I would dig into bigger pockets, do a little research, and see who's doing it and doing it well in Florida.
All right. I found Danielle's original question. So we're going to go off that. Is it better to get a loan from the bank or from a broker? So we've talked about this. I mean, I don't know how many times here. And I'm not a mortgage broker. I'm not a mortgage professional. I've been in the broker days in my past, but there's a difference, right? Banks typically have access to their programs, right? You walk into a bank, a Chase, for example, a Wells Fargo, depending on where you are, a BB&T or whatever the bank might be, and they have their programs, right? They don't really vary from those, what have you. A broker, for example, has access to those banks in many cases, plus many, many more. Josh will tell you he's approved with, I don't know what, 25, 30, how many brokers? I mean,
23, 24 different lenders.
Yeah, so 23 different banks. So if your scenario doesn't necessarily fit in box A, he can go see, check out and see if it fits in any of the other boxes for lenders. At the same time, he can shop your interest rate. If you walk into a bank, they offer these rates, whatever the rates are. Josh is able to compare those rates versus the other 22 brokers, banks that he's approved with, and shop the best interest rate. So, brokers offer not only, an option for better terms, more open guidelines, but an ability to work with an expert in many cases, which I think is an important piece here. Typically, you're walking into a bank most of the time. Now, this isn't all of the time because there are experts that work at the big banks and what have you. But most of the time, you're dealing with somebody that is just taking an application that doesn't truly understand loans in those cases, and that's where a broker would stand out. But Josh, I'll let you do your 30-second sales pitch here on the broker side. I should have just thrown it your way to begin with.
Yeah, no, we're good. We've both covered it a ton. So what I would say is exactly what Jeb said. They have limited products. They often have overlays, added guidelines that they made because banks are more conservative that don't apply. And then for the most part, by all means, I know experts that work at banks, but the majority of loan officers at banks are closer to bank tellers than mortgage experts. So the ability to shop more programs will generally get you lower rates, lower fees, better service, and more expertise. And a bank loan officer is going to be pretty hard to get a hold of if you need them at 7 p.m. or at Saturday at 2 o'clock. I'm not saying I love it when I get calls and texts on the weekends, but it happens. 2-3 calls, we take 5 minutes and go through and get you your information. So by all means, shop them all. I tell anyone, I'm never offended by you talking to 2, 3, 4 sources, because I think when you're done talking to 2 or 3 or 4 people, it is even more apparent that we're the better option for you.
No, good. And then the follow-up question she asked was, do you need to pay any additional charges to get a loan with a broker?
Absolutely not. The fees are going to be the items that get charged are going to be the same wherever you go. On our end, we don't charge a processing fee. A lot of the banks don't. Some do. It's more common among banks than it is with lenders. So at the end of the day, all of the things need to be done on a loan, whether you go to one source where the bank does everything, or whether you go to a broker that does a bunch of it and then hands it to the lender for underwriting and funding. So no, absolutely no additional charges for working with a broker. And you're just more likely to get lower rates and fees because of our ability to shop and find out who has the best terms on any given day.
Got it. So I got a good question here for you, Josh. Not the softball. I mean, it's going to be a softball, but it's a smaller softball. It's harder to hit. I get a lot of overtime. I make $55,000 base, and in the last 2 years, I made $115,000 in each of the years, $60,000 each year. How much of my overtime will they use? So he made $60,000 overtime the last 2 years.
So here's the thing: overtime, it's not essential that it's overtime. Any variable income, which overtime is not guaranteed, it can vary from month to month, is going to be averaged over the last 2 years and year to date. So in this instance, you got 60,000 both years. You're going to get credit for all of the 60,000 of overtime, assuming that year to date we're in the middle of June, somewhere around $30,000 year to date. So as long as it looks like 2021 is going to be on track for the same amount, we're going to use all of it. Let's say you've only got 20,000 year to date, so it looks like you'll end up at 40 at the end of the year. They'll use the lowest figure, so we would use the year to date average of 20,000 across 6 months. So what does that give you? Instead of 60 grand, it gives you 3,500, 3,300, somewhere along those lines. So, and that applies to any variable income, bonuses, commissions, anything that's not guaranteed, like a salary or an hourly rate.
Now, don't they need proof that it's going to continue to some?
No.
They don't. Okay, there you go.
As long as the employer doesn't state that it's not going to continue, the receipt for the last 2 years and year to date is generally accepted as continuance, because most employers won't do it. When you say, hey, I want to know that he's going to get that overtime going forward, they go, I don't know. COVID-2 could hit in the fall and he would have no overtime. So employers won't provide it.
Got it. Good stuff. Bernardo Martinez Sr. I have a family member who bit off more than he could chew during the housing fever and now house poor. Should he wait it or relist now to get out since he could be foreclosed on? So I don't know the full situation there, but if he's in a position, he or the family member, she is in a position where they can't afford the property, then yeah, selling it's probably the best option. Trying to hang on and do that may not work out, but if they're in a position where they can hang on for a little bit, they might be in a better position with regards to equity. It's just really hard to say. It's hard to tell somebody to stay in a property if they truly can't afford it. The question is, do they have enough equity in that property to be able to sell it and not have to pay any money? And if so, great. If not, do they have the money to be able to do that? Because otherwise it requires short sale, so on and so forth. So, there's a lot going on there. Talk to a professional in your market. If you need one, reach out to me. I'm happy to put you in touch with somebody that can, because you need to look at the numbers. I think the numbers will help you, but there's, I think the underlying question is if they can't truly afford it, then they need to do something one way or the other.
The follow-up from Bernardo might be more interesting than the original question. The reason why I asked is because it makes me wonder how many more of these situations exist. The housing fever was crazy and many agents took advantage of first-time home buyers. So let's go with the second part first there. Yeah, there were people crazy making offers. An agent can't take advantage of a buyer. They can show them a house and they can offer to help them write an offer, but the buyer had to contact them and say, I would like to buy a house. They had to go to a lender and get qualified for the loan, and they had to have money for their down payment and closing costs and have thought seriously about whether they should do it or not. So at the end of the day, I've done this for 26 years. I've never seen a realtor pull out a gun and put it to someone's head and make them buy a house. You have to have some personal accountability at this point. Were there bad decisions made last year? Yes. Did realtors facilitate it? Did they talk people out of buying homes? No. But again, I've never seen someone hold a gun to a buyer's head and say, hey, you're going to buy this.
No, agreed. Yeah, I wasn't even going to address the question once they threw it and said that, agents took advantage. I mean, there's always an excuse for everything, right? Yeah, yeah, I'm not even going there. Anyway, here we go. I was looking at the time and trying to read this. James Lee. I have no idea. Anyway, is it better to buy I just skipped over 2 super chats, which I'll come back to buy a foreclosed home? If so, how would one go about it? So, in this market, if you think you're buying a foreclosed, I'll just start with this. If you think you're buying a foreclosed home and you're going to get a deal, not going to happen. So the question is, why would you buy a foreclosed home over buying an existing home? That's the first question. There's a lot of risk with buying foreclosed properties because you don't know, depending on where you buy them from. If you buy them from the courthouse steps, and you didn't do your due diligence and what have you, there could be a lot of underlying issues going on with that property. So there's a risk that's associated with that. And if you buy them from, a broker or somebody that's taken over the property after it's been foreclosed upon and it's an REO or what have you, that's a whole different situation. Most of the issues that you could have had buying it from the courthouse have been rectified, if you will, taken care of. But the question, is it better to buy one? I don't think it's better. 10, 12 years ago when there was a lot happening and there were a lot of foreclosures, it was possibly saying better then, just because there was, an opportunity to get those homes at a lower value. But towards the end of that, those homes were selling at, pretty close to market value. So, I mean, I don't think that there's a deal to be had at the moment.
Jeb, what we always talk about is supply and demand. At that time, there was a monstrous supply of foreclosed homes, very little demand to buy them, and the banks that owned them had very little interest in holding them. So they were motivated to get them off their books. That's why there were monster discounts in 2008, 2009, 2010, and they were mostly gone by 2012 because there were prices had stabilized, there were more buyers. So supply demand comes back in line. So again, there's nothing inherent about a foreclosure or a short sale that makes it sell for less or be cheaper than any other home, other than supply and demand dynamics, which we do not have right now. Any property that comes on the market has a lot of demand, and it will get to a market value price.
Got it. We had received a super chat from Freddie. Thanks for answering my question earlier. Josh, I'll be in contact with you later this month regarding refinancing.
You forgot the important part.
What's that for? The beer at the end?
The 2 beers there for this guy.
Bro, you're not getting anything.
You're
out of commission.
I'm gonna hijack your account and get access to it.
And then Robert Bryce also gave a $5 super chat. So thanks, guys, for doing that, supporting the channel. Appreciate you being here. And then Bernardo had a follow-up saying that the reason he asked because his agent kept telling him to pull more money from his account to bid more. Tell your agent to go pound sand. Find another one.
If you're getting pressure and they're pushing you to do something you're not comfortable with, that's not cool. We already talked about it. There's more realtors than we need in this world. Go find a better one. Go find another one.
There definitely are. I know a lot of them. Anyway,
and we can say the same thing about lenders. So we're equal opportunity offenders around here.
Let's see. We're pushing hour and 55 minutes, so we're coming to the end here.
So hold on. We got Rey Campos is trying to do the same thing that Robert Bryce did, saying, "Check my questions too, please." I can't find him. You finding him?
What was? I did.
Hold on.
I saw.
We got his question.
Right.
Okay, getting ready to close on a purchase price of $650 with 10% down. The property appraised for $790. Can the lender get rid of PMI? What are the pros for having a higher appraisal?
Good question.
So no, they cannot. So your loan to value for loan purposes is based off of the lesser of the purchase price or the appraised value. So in this instance, it's the purchase price. So you're putting 10% down of the purchase price. You're at 90% loan to value. You'll pay mortgage insurance. Now, when can you get rid of it? Because you have the value there with a 790 appraisal. So what will happen is after 6 months, you can get a new loan using the new appraised value. Anytime in the first 6 months for Fannie Freddie guidelines, the primary loans with no mortgage insurance, they require you to go off of the sales price. After 6 months, we can use appraised value, get rid of the mortgage insurance. So what I would absolutely say, what does this mean? We talked earlier about, do I pay points? Do I pay closing costs? I would make sure 100% that you're getting a lender credit to cover almost all of your costs here, because you're going to look at refinancing here in 6 months as soon as you hit 181 days and can use the appraised value.
Got it. No, good stuff. We'll answer one more question, but you have to say the name.
Sarab Garg.
There you go. That's actually pretty good.
Boom.
There you go. The property I'm considering buying has appreciated by 30% in the last year. Should I expect to pay 2022 property taxes off the sales price, or will the tax assessment take time to catch up? Chances are it's going to take time to catch up. Here in the state of California, you wouldn't have to worry about that 30% increase in appreciation, but other states you do. But typically it doesn't happen immediately. It takes a little bit of time for the tax assessor's office to get caught up. So that would be my guess if I had to guess, which I guessed. And so that was my guess. And that's the end of the show. Anyway, we're pushing 2 hours here, guys. I appreciate you being here. Thanks for the support. I ask that if you found any of the information valuable, the content helpful at all, hit the like button. Maybe share it with a friend, have them subscribe, follow up, ask your questions. We'll answer them next week if you're watching this later. Josh, anything you want to add to the end here? Finale, 200 people watching.
No, we covered a ton. We got our contact info. We'll get out here to you guys. Where in the heck did we put it, Jeb? You made fancy new banners here.
Yeah, no, this is going all. It's like, what's going on here? Banners. Let's see here.
So by all means, many of you have a lot of questions that are deeper than what we can do here on this live stream. So by all means, email Jeb, email myself. More than happy to help you.
That one.
And if that help means connecting you to an expert in your state, we have a big network around the country that's going to take care of you.
Yeah.
So
no,
yeah.
Absolutely. Yeah. If you guys need a great lender, great, realtor, reach out. A lot of viewers reach out all the time, and we connect them. In fact, had 2 close last week here in California that I'm aware of that got connected with great agents. And Josh, we're sending referrals out all the time. Then people are getting help and reaching back out to thank us. And we're not doing it for the accolades, just doing it to make sure you're getting taken care of and finding somebody that's going to do a good job, because that is, when you're new to this, it's really hard to know if you can trust someone, and getting that referral is the best way to know that you're in good hands. So that's where we are. See you again next week. Be back Wednesday live at 5.
Live at 5.
See ya.